Recently, I need to answer some questions about passive investment that my husband and I need to make decision on. And I know the same topic interests some of our friends and relatives. So I made this video to start with on how I answer the questions through data-driven modeling. I hope it can inspire more people. Welcome to discuss and exchange ideas. There are no right or wrong answers most of the time when it comes to investment, but it is about how you make better decisions after looking at some numbers with proper modeling. The questions to be answered in this video is, if I have 100K spare money, where should I invest to maximize long-term gain in the US? I built a model to compare side by side between real estate and stock market, which are the top choices for us. In this video, I'm going to cover 3 parts. Number 1, use one scenario to explain the side-by-side comparison methodology in a nutshell. Number 2, demo in the actual data-driven modeling with different scenarios and facilitate our decision-making. Number 3, pros and cons and conclusions. So I bought my first house in China, a 2-bedroom condo, when I was 24. 10 years later, when I sold the house, it was 8 times the price I bought. So far, I've purchased a few houses for both living and investment. Some I've sold, some I bought together with my husband. I also tried stock market and so far it hasn't been good. So I feel I may have bias towards real estate. Therefore, by doing this side-by-side comparison, it really provided us a clear view and decision to make. Let's get started. Assume we have 100K spare money to invest today. I'm using a very conservative annual growth rate in this in the house market, 4% compounded annual growth rate. This is a very conservative rate based on my research and experience. If you can get a house that has higher growth than this, it is extra bonus in the end. Remember, I try to prove that I'm not biased towards real estate. Therefore, the growth rate estimation I use here on real estate is fairly conservative, meaning in reality, you should be able to get a much higher growth. We're talking about in the long run, not about financial crisis or any of the economy downturn. Now, the interesting part comes. Firstly, if you are qualified to a 75% mortgage loan or 300K here, immediately you can buy a 400K house. As long as the interest rate is in a reasonable range, this amplifies your investment capability. Secondly, if you can manage to get net rental cash flow positive during the years you hold the property, this is another bonus. This is not our focus today. I will make another video talking about how to choose investment properties to maximize net rental income and cash flow. Let's just assume this cash flow is 0 to keep the math simple. One thing I want to mention here is that the tax return on house depreciation will not be included here, given the depreciation will be deducted when you sell the property. And most people are on a higher tax bracket when you are younger than the long-term capital gain tax rate when you want to sell later. Now, let's look at the stock market or any funds you want to invest in. SP 500 annual compounded growth rate in the past 30 years is about 8 to 10%. Let's use 8% to start with. 15 years later, you decide to sell the assets. assuming you took a 15-year loan here, with a 4% compounded growth rate, the 400K house price will be 720K. With 8% annual growth in stocks, your asset will grow from 100K to 317K. Seems much better growth in stocks, right? However, your gross profit on the house is 570K after paying commission and closing cost, which is roughly 7%, and deducting your original investment 100K. While in stock market, your gross profit is only 217K without the two growth vehicles highlighted here. Another interesting part is tax on the long-term capital gain. For the house, the tax is on top of 320K instead of 570K because you already paid tax over the years on the principals paid in your mortgage. Now you can see the net profit between those two investments, 522K versus 184K, or 522% return on the investment from the house versus 184% in stocks. It's not the end of the story yet. If you have very good experience with stock market and can beat SP 500, you have a better chance to beat real estate. 12% annual growth rate, not yet. 14%, not yet. In this scenario, if you can reach or exceed 15% annual compounded growth in stock market, you are the winner. Your net profit or ROI will exceed real estate. You might be curious, how does it look like if you do better than 4% in real estate? What if you can only get 60% loan? What if you want to do 30 years loan to maximize cash flow? What if you want to sell the house in 10 years before the mortgage is fully paid off? Now I'm going to switch to Google Spreadsheet and demo in different scenarios that I'm curious about. In this model, we have 4 key inputs based on your own situation. They are the mortgage interest rate you can get, loan ratio or LTV you can get, total years of your mortgage, and your long-term capital gain tax rate expectation when you sell the assets. Let's use 20%. Another 2 inputs we can play around are first, average annual growth rate expectations, 4, 5, 6, 7, 8% for real estate and double it for the stock or funds market. Number 2 is the commission plus closing cost you need to pay for selling the assets. For house selling, basically it's 6% seller and buyer agent commission plus closing cost, 1%. Of course, this depends on the value of the house. It could be lower or higher than 1%. So in total, 7% we use here. With these default inputs, I have modeled out what the investment look like if you want to sell the assets in 5, 10, 15, 20, and 30 years respectively. Similar to what we have gone through earlier, we have house price after X years, gross profit after X years, outstanding loan, tax on capital gain, and finally, net profit after X years, which is our final goal. With the current combination of the inputs, you can see even if you only have 4% of annual growth in real estate with much higher commission, Because of the leverage of loans, you still gain more than most of the scenarios in stock or funds, especially if you want to cash out earlier, like 5-10 years, for example. Given the most common loan years are 30 years, and it's hard to keep cash flow positive every year if you do a 15-year mortgage. Let's change this from 15 to 30. Now the results change a little bit, but didn't change the overall conclusion. Now let's see how the model changed if you do a 50% loan instead of 75% loan. See the big shift? Now, in some scenarios, it's worse. That's because we lost the power and leverage of mortgage loans or good debt. What about interest rate? Let's change the LTV back to 75% first. Now, let's change the interest rate to 2%. You can see a little bit more gain compared to 3%. Change the interest rate to 4%. A little bit less gain, but it doesn't change the overall conclusion. Of course, when you have higher interest rate, you need to monitor your annual cash flow. If it becomes negative, we need to discount it in the total return here. If you want it to be more sophisticated, we can do another episode in the future. Everything comes with pros and cons. Here we go. The pros of investing in real estate are you have the leverage of mortgage, especially when the interest rate is relatively low, meaning your annual rental cash flow can be more positive. And all the expenses like loan interest, management fees, and property taxes are all tax deductible. The cons are it's not liquid, and there's a risk that the house market could go down when you want to sell. And if any of the tax policies change, you may face higher expenses and lower returns. In conclusion, if you decide to invest in real estate, you should optimize and maximize your mortgage loans when you can, and make sure all the risks are manageable. For stocks or funds, the pros are a lot less headache dealing with all the paperwork and property management companies, or even the tenants yourself. And of course, the assets are a lot more liquid. You can even sell a fraction of the assets. The con is not much leverage as compared to real estate, unless you are really good at buying stocks on margin. In general, if you have more than 15% compounded annual growth from the stocks or funds, you should hold on to it or even invest more. But don't just look at the good years. Do an apples to apples comparison. Finally, a couple more tips on real estate. Number one, maximize your mortgage loan when you can, while not stretching yourself too thin. Number two, plan to sell during the years when you have less taxable income. For example, after you retire, you could save 5 to 10% tax on the long-term capital gains. Number three, get adequate insurance so you minimize your risks. For example, flood, fire, earthquake, based on the risk level of the location you chose. Get umbrella insurance that gives additional layer of protection. That's all for this episode. Thanks for watching.